So this will be a reaction video to one of Graham's latest videos, as I have just filed my taxes recently. We'll see if I regret listening to this sooner. Remember, this is a reaction video, not an analysis video. So this will be my thoughts as they come, and not a deep down dive into each in particular thing that he's saying.
What's up, guys? It's Graham here. And if you pay any amount of tax whatsoever, you need to hear this, because chances are you're wasting a lot of money.
As you can see here, we pay a lot of taxes. This is what the overall overlook is. So it'll be interesting to see. My guess is he's going to focus in on this amount. These are the percentages at which the federal government gets most of their tax money or revenue from.
Don't believe me? Well, just consider that here in the United States, the average single worker paid 30.5% of their income to taxes, meaning 1/3 of your entire working year is spent just earning enough to pay the IRS. And that's unacceptable. The fact is, most people have perfectly legal ways to reduce their tax bill by a lot that almost no one talks about, and the IRS isn't out there telling you about these things, because if they did, let's face it, they would make a lot less money. That's why we need to discuss exactly how the tax system works, the best ways to save a lot of money in your taxes legally, and break down the most underutilized tax strategies that anyone would be able to use immediately, whether you make $10,000 or $10 million.
I'll be interested to see if he has any advice that I haven't heard before. And again, if there are ways you can get your taxes lower, by all means, I say do it. But long term, I really hope tax reform is made in such a way in which this is no longer a thing, because typically for those with means, there are way too many tax loopholes.
Oh, and also just keep in mind, this is not financial or tax advice. I am just a random guy on YouTube. Do not rely on me. Go and consult a professional. So if you understand that, thank you so much, and also big thank you to Rocket Money for sponsoring today's video, but more on that later. All right, so when it comes to paying less in taxes, the secret is to make your income look as low as possible without actually reducing your income. And no, this doesn't require you to take out loans against the arbitrary value of assets. Instead, one of the first ways you could go about doing this is by contributing to a traditional 401k.
100% contribute to your 401k. It directly drops your taxable income. When you do withdraw it decades from now, what you withdraw will be taxable then, but it does lower your tax exposure now. And frankly, this is how most people in the modern day have actually become millionaires, is through their primary home ownership and then consistent long-term investment and growth into their 401ks. It gets a lot of bad rap by people who have alternative motives, but overall, it's a relatively good product, especially if your employer offers a decent match.
This is a tax-advantaged retirement account that allows you to contribute up to $23,000 a year of pre-tax money, meaning every $1 you contribute reduces your taxable income by that very same $1. This way, you show less in income, you pay less in tax, and you have more money left over to invest with. And if that sounds confusing, here's an example. Let's say you make $65,000 a year and you contribute $15,000 to a traditional 401k. In that case, now you're only taxed as though you made $50,000, and in a 22% tax bracket, that's an immediate savings of $3,300. Even better, but some employers will even match your 401k contributions dollar for dollar up to a certain amount, essentially doubling your investment risk-free. But there is a bit of a catch. The downside is that you'll eventually have to pay taxes when you take money out of the account in retirement.
There are a lot worse downsides that could be happening. And frankly, I don't even consider this a downside. Please let my, what would be currently taxed money, go ahead and work for me, make thousands of more dollars, and I'll happily pay my tax bracket then tax rate when I pull it out decades from now. So not that much of a downside.
Which is typically going to be at the age of 59 and a half. And at that point, the tax bracket could be a lot higher in the future than it is today. So from my perspective, it really only makes sense in two scenarios. The first is when your employer offers a 401k match, which if that's the case, you should almost always take it no matter what, because you're doubling your investment risk-free. There's no reason not to do this. And second, a 401k also makes a lot of sense if you're currently in a high tax bracket and you expect to retire in the future in a lower tax bracket. Then you could just profit the difference. Although for most people out there, a 401k is a fantastic resource to lower your tax bill. And that also leads me to something slightly better, and that would be what's known as a health savings account, or HSA.
It's a trap, and I disagree. Now I'll be interested to see what he says to see if I change my mind. But for any of you that may end up having any health trouble whatsoever, being able to qualify for a health savings account requires you to take your employer's worst insurance plan. It looks great on paper, but God forbid you have any medical emergency, and God forbid you have to go to any other hospital that might be considered in-network, or when you're traveling or whatever, you could be screwed over with huge medical bills, not covered by your insurance, and that depletes any potential savings or saving rates from your health savings account. It will lower your tax bill for that year, but please don't jump on this unless you are in absolute stellar health. As you can see, I'm a little bit butthurt with this. I did follow for this route and I ended up having some medical emergencies, and it cost me more than I was allowed to put into my health savings account for that given year, and I was a little bit butthurt.
This account is specifically used to pay for any out-of-pocket medical expenses or charges that you incur throughout your lifetime. even better, but you're able to invest this money to grow your tax savings even further. And here's why I would consider this to be one of the best tax-advantaged accounts to ever exist. First, you don't pay tax on any money that you contribute to this account, which in 2024 is $4,150 a year. Second, you're not going to be taxed on that money when you spend it on health-related expenses, which we're all going to have at some point in our lifetimes. So that's also completely tax-free. It's basically like you're getting completely tax-free money to invest that you will never have to pay taxes on when you spend it on eligible expenses. And in a 22% tax bracket, that's a net savings of $1,000 immediately for maybe 10 minutes worth of work. However, just keep in mind that in order to qualify, you must have what's called a high deductible health plan, which means in 2024, you have a deductible of at least $1,600 for individuals and $3,200 for families, along with some other fine print to follow depending on your state. But assuming you fit the criteria, this is one of the best ways to save money in your taxes, hands down, for the least amount of work.
Before he goes on to the next point, I am going to stress again, please only do the health savings account if you and your family can swallow the max out-of-pocket contribution well if a medical emergency happens. Again, for the qualified plans that this would cover, it is the higher amount.
The third, one of the largest U.S. tax breaks in existence that anyone could use today is by taking advantage of what's called the long-term capital gains tax rate.
100%. The tax rate for long-term capital gains is far less for most people's individual income tax rates. So if you are planning on selling any stocks or positions, it is really important that you keep into note of how long you've held said position. So if you've held a company for like 10 months, you'd get taxed on it at your current tax bracket rate. But if you're able to hold on for another 2 months before you need to sell, the tax rate that you'd be getting taxed on is far, far less.
Just consider this. If you buy an investment and you sell it for a profit within 12 months, that profit is considered earned income and taxed at your ordinary income level, which could be as high as 37% plus state income taxes. However, if you hold that investment for longer than a year and then you sell it for a profit, it's taxed at the long-term capital gains rate, which, as you can see here, is significantly lower. In fact, the federal long-term capital gains tax is only 15% if you make between $47,000 to $518,000 a year. That could lead to a massive savings for anybody who makes more than 50 grand. Even better, if you make less than $94,000 a year as a married couple filing jointly, you'll owe nothing in long-term capital gains, meaning your profit is completely tax-free. As in, theoretically, you could make $94,000 a year and pay the IRS $0. On top of that, qualified dividends also get the very same long-term capital gains tax treatment on stocks that you hold for more than 60 days on approved US-based and foreign companies. So consider that the next time you're about to bet on short-term call options because you saw it on Wall Street Bets.
Just make sure when you are looking into high dividend yielding stocks that it is a qualified dividend. Overall, it's a pretty easy search. Just make sure you search for it. Otherwise, it will be a surprise on your tax bill. Also, something else that he hasn't mentioned up or talked about yet, your high yield savings account for your bank, even though they sometimes view it as a dividend, it is not a qualifying dividend. It is paid out and you are responsible for it in your general income, and you have to pay taxes on it as if it's normal earned income.
Anyway, I'm getting sidetracked here. This is why I personally love the strategy of buying and holding long-term broad-based index funds. Not only does this tend to be safer and yield higher returns, but it's also way better when it comes to your taxes. And the more money that's saved, the more money you could use towards our next option, which happens to be my personal favorite out of the entire list. Fourth, in terms of my favorite way to reduce your tax bill, as someone who's self-employed, one of the best methods that you could utilize as soon as possible is by setting up what's called an S corporation or an LLC taxed as an S corp.
With all candor, I have no experience on this topic, so I look forward to learning just as you.
This is simply a legal entity that you create to run your business through. In essence, all of your self-employed income goes into the S corp, expenses come out, and then you take what's left over as a profit. And yes, if that sounds confusing, let me break it down a little further. In very basic terms, with an S corp, the S corp becomes your employer, and you become the employee. This means that you get paid a reasonable base salary, and then all the profit is given to you later as a distribution. Why does this matter? Well, distributions made from an S corporation are not subject to Medicare and Social Security taxes, which could save you 15.3% on your money. And that adds up quickly. For example, if you have a business that makes $120,000 a year in profit, and you pay yourself $60,000 a year, you're saving over $9,000 in taxes by taking that remaining $60,000 as a distribution through an S corp. Now, obviously, this is something you should be talking to a CPA about. There's a lot of very specific requirements that need to be followed, and you shouldn't just listen to some guy on YouTube for your tax information. But I figured I would at least plant the seed. And if you want to water the seed and grow it into a tree to save 15.3%, Be my guest. Now, fifth, while we're on the topic of S-Corps, if you live in a state like California, New York, or New Jersey, or practically any state with an income tax, there's some good news in what's called a SALT cap workaround. See, in 2017, the Tax Cuts and Jobs Act limited the amount that you would be able to deduct for state and local taxes, like property taxes or state income taxes on the federal level. This meant for a lot of people, they wound up paying a lot more money in tax than they did before. However, that wasn't until recently. Some states have issued guidance on what they call a SALT cap workaround that allows you to deduct your state income taxes in their entirety, saving you a ton of money. And here's a very simplistic view of how it works. Instead of the S-Corp owner paying themselves the full distribution and then the owner being required to personally pay the state income tax, the S-Corp will pay its portion of the state taxes as a deduction since that's not limited by the $10,000 cap, and then that credit will transfer to you on the individual level, essentially allowing you to use it as a tax write-off. Don't believe me? Well, so far, 30 states have already approved the strategy, and the IRS even issued their guidance on how to proceed with it. Of course, you should check with a professional.
I really hate all these loopholes or workarounds. I really think it's, again, benefiting very few amount of people in the US in the first place.
It's not going to work in every situation, and don't rely on some guy on YouTube or anybody on YouTube for advice like this. Go and consult a professional. But it is something that you might be able to discuss with the CPA to see if it's possible. Next, 6, for all of the homeowners, there are substantial tax breaks you might not be aware of. So here's a pretty extensive list. 1, the capital gains exclusion. This allows you to sell your primary residence and pay no tax up to the first $250,000 worth of profit if you're single, or $500,000 worth of profit if you're married, as long as you've lived in the property for 2 of the last 5 years.
Absolutely wild. Never get why this was made into a law, but it really does help and benefit a lot of people when they sell their homes. It helps roll over the money into the next house.
To show you just how good this is, imagine you bought a property in 2018 for $500,000 and today it's worth $1 million. Ordinarily, if you were to make $500,000 as a long-term capital gains, you would have to pay 20% or $100,000 in taxes. But with this, you pay nothing. Now, the downside is that this doesn't apply to state taxes, but still, a 20% tax savings is something to absolutely keep in mind. Second, we have the 1031 exchange. If you own a rental property, one of the benefits is that you're able to indefinitely defer paying taxes when you sell, as long as you exchange that property for another one within a certain time period. For example, let's just say you bought a rental property for $100,000 and today it's worth $300,000. Normally, in that case, if you were to sell, you'd have to pay taxes on $200,000 worth of profit. But instead, if you did a 1031 exchange, you would be able to sell that property for $300,000, move that into an even bigger deal, and all of a sudden, you've just traded up without paying any tax up front. And no, you can't do this on a primary residence, but if it's a rental property, this is absolutely something to look into. The third, depreciation.
I feel like many of the loopholes are found in real estate. Whether that's wrong or right, it really only benefits those who actually have a lot of money and wealth to begin with. Overall, I'm not a fan of any of the loopholes. And depreciation, that should have been counted in your whole investment game, and I don't really like it.
This is often how people can make thousands or even tens of thousands of dollars a month in profit, but on paper, they're showing a loss and owe absolutely nothing. And here's a really simple breakdown. According to the IRS, your property structure has a lifespan of 27 and a half years. Their reasoning is that the property over time tends to deteriorate, things need replacing, and this needs to be factored into the cost of ownership. So this is where depreciation comes in. If you have a structure that's worth $275,000, you would take that, divide it by 27 and a half years, and all of a sudden, now you have $10,000 a year in depreciation that you could write off against any profits. Now, separately, if you want to get really fancy with this, there's also a term called cost segregation analysis that allows you to depreciate all of these items upfront in a much quicker time frame. And then when you have nothing left to depreciate, you can 1031 into a new deal and start the process over again, potentially deferring millions of dollars in taxes.
So wrong. It's one thing for putting that money back into it or actually repairing it, but this seems to be a recipe for lots of slumlords.
However, full disclosure here, it's very complicated. You have to leave it up to the professionals. And fourth, if you don't want to sell, but you still want to have access to your money, then you also have a refinance. Now, unfortunately, this one doesn't make too much sense with mortgage rates as high as they are. But when and if interest rates eventually come back down, it is a strategy that's worth discussing. And it's just this. In the eyes of the IRS, any loans you take out against assets aren't technically income because you didn't technically sell. And as a result, you don't owe any tax. As an example, let's say you have a property that you bought for $100,000 and today it's worth $200,000. If you were to sell, you'd have to pay tax on that $100,000 worth of profit, which could be 15 or 20%. In that case, you could avoid taxes entirely by taking a refinance, borrowing against the equity you already have in the house, and because you didn't sell, you owe absolutely nothing to the IRS. And finally, fifth, we have a very nuanced, very specific tax break that not a lot of people know about, and that would be the real estate professional status. IRS. See, typically, if you have a W-2 income, you're very limited in terms of your write-offs. For the most part, your income is your income, and there's not much you can do about it. However, if you or your spouse qualifies as a real estate professional, that is where some of the magic happens. In this case, you would be able to use all of your real estate paper losses to offset your W-2 income, and all of a sudden, you owe absolutely nothing to the IRS. As an example, let's just say you make $100,000 as a W-2 employee, your spouse qualifies as a real estate professional, and you have $100,000 in real estate losses through cost segregation. This would imply that the paper losses through real estate cancel out all the income as a W-2 employee, and all of a sudden, $0 in tax.
Graham's done an excellent job with this video, but so far it's just kind of ticking me off and putting me in a worse mood.
Now, obviously, being a real estate professional is something that you'd actually have to back up to the IRS in the event of an audit, and this includes spending more time doing real estate activities than all other business activities combined, and spending at least 750 hours a year in real estate. But if you qualify, you're welcome. And lastly, just make sure to hire a good CPA. The main purpose of this video is just to be able to give you ideas and strategies to look into further. But at the end of the day, the tax code is so unbelievably complicated. Every strategy is going to be different. There are a million moving parts, and you should always rely on a professional for any advice that you take. I spend well into the 5 figures every single year on tax advice and to make sure everything is done correctly, and even though I doubt you need to spend anywhere close to that, you need to hire a professional for this. It's not really something you'd be able to just do yourself. My thought is that a good CPA hired early in the year is going to give you the best tax strategies possible to be able to structure your business in order to pay the least amount of tax possible. And if you wait and do this later, some of them might not be available. That's why I'm choosing to make this video as early in the year as possible, so that way you can get on top of it, do everything you need to correctly, consult a professional, and no matter what, subscribe and hit the like button if you haven't done that already.
So overall, well put together video. It wouldn't have changed anything I did on my taxes. I've already filed. A lot of benefits and loopholes as it will for those who own real estate and move a lot. But otherwise, make sure you contribute to your 401k. Be leery of the health savings account. If you're buying and selling stocks, try to hold on for it for at least a year, because the tax rate will be 1,000 times better, and a lot of perks if you own your own business and or properties